Sampath Reddy also joins us on the show right now, of course, the founder and fund manager at Azurean Investment Managers. Hi, Sampath, good to be speaking with you. Let's begin with IT itself because, yes, there is a sentiment uptick that we have seen since the US election, but do you think it will likely convert into earnings as well or not?
I think, at this moment, most of the analysts are of the opinion that with the tax cuts, expectation of the tax cuts by the new president, there is a possibility that, corporates might spend more on the IT side. I think that's what is, leading to that, optimism. But I'm not sure, whether the commentary has been, where the earnings have come for the Q2 numbers. If you see, mostly the momentum is waning away. I think the growth rates are, below the expectations for the Q2 gone by. I would not be at this juncture very optimistic about the way, how it will pan out for the, when the new president takes over. Probably we'll wait and see whether, the order books or, the new, large orders are coming through the IT services companies. I think, it's better to wait and watch than, jump the gun and see how the order books will pan out for the IT companies.
Okay, let's see how it really pans out. For now, yes, that overall expectation that discretionary spend will go up and BFSI's bottom is definitely helping the street. But what about consumption, Sampath? And I'm talking about, the urban consumption bit, which was doing well earlier. But if you look at this quarter's earnings, whether it's QSR, whether it is paints companies, whether it is some of the durable names as well, it hasn't really lived up to expectations and earnings have managed to miss the estimates. What's your take on this?
Right. I think, overall this Q2 earnings which have gone by has been quite weak. I would say, most of the places there has been a sharp decline in earnings, especially even in the consumer side also the earnings growth has been disappointing, both on the volume front and even on the margin front as well. So that has been a sort of a disappointment for the, overall at the sector as such. Even if you look at the paints or, even if any other sector, if you see with the general consumer, QSR, most of the places the volume growth has been anemic and the price growth was also quite poor, and there has been a margin pressure as well. So because of that, overall the earnings have taken a beating. But these are the good companies and good sectors to stay invested even at this correction which we had seen in the last couple of weeks based on the poor earnings. I would still think the valuations are slightly on the higher side. One should maybe pick and choose few of the companies where they've corrected meaningfully, given the growth opportunities that the sector offers. Some of them could be from the QSR per se. Given the stocks have corrected, even though earnings outlook is very poor right now in the near term, the growth outlook for the longer term perspective is very, very strong. Some of these pockets where you can find the value and stay invested for the longer term perspective. But yes, the near term, the growth has been quite poor and disappointing in terms of numbers wise.
Autos, though the numbers have largely been in line for the second quarter, but the overall demand environment clearly looks to be growing a little bit slow. This was quite reflective in the management commentary, other than, of course, outliers like an M&M, wherein the tractor sales as well outperformed. The festive sales, it's picked up in the last 2 weeks, but it's really not, as great on a year-on-year basis right now. Majorly, it's largely on the back of higher discounts that most of these auto companies actually doled out. Wanted to understand, where is it, Sampath, that your preference lies within autos now?
Within the autos, especially the both the two-wheelers as well as four-wheelers, we really like them. And given that these are a relatively very high ROE companies, we've been liking them. And also there are select pockets where in the ancillary and auto ancillaries also there's value emerging in spite of the relatively poor volume outlook that we had seen in the last couple of months. I would think that especially the two-wheeler side, the opportunity is quite good, and some of the leading companies have already moved, rather made quite a good inroads into the EV side of the vehicles as well. So both the two-wheelers as well as the four-wheeler, passenger car OEM makers and some of the ancillary companies are also looking good from the valuation perspective.
Okay, some of these names are looking good from a valuation perspective, but just taking stock of what else is happening in the market and what's buzzing is, of course, some of these lenders, the likes of PFC, REC as well. PFC came out with a good set of numbers. Even Power Grid, for that matter, post its earnings, have been seeing that up move. Naresh, do you have a view on some of these power utility names which are perking up in REC, for instance, PFC, Power Grid?
So the whole pack looks interesting. PFC, as a matter of fact, has given a breakout today after making a good base around that 440 to 430 mark. There were at least 3 to 4 bottoms around that area in the last 1.5 month. And the interim highs around 475 have been crossed today. So a clean breakout here. Also, the stock came back all the way to the prices where it was on June 4th. So a good correction also from the top of around 580. Looks like setting up for a move towards 520 to 550 in the short term. Power Grid similarly went through a correction, slow drift, and has been sideways for the last 6 months roughly. Short-term breakout here, but would prefer a PFC REC in this pack as such.
Okay, well, let's take a very quick break on that note with news that we're still pretty quiet right now for the index. Heavyweights like Reliance, L&T, M&M, Bajaj Finance, all in the red as we speak right now. Even Tata Motors has given up most of its morning gains. But yes, on the flip side, you've got a bit of a tug of war with the IT pack on the one hand and names like HDFC Bank along with Maruti, which are also holding out quite okay, as is SBI.
Well, there's commentary coming in from the Excite management at the bottom of your screen. For now, the stock is pretty much flat. We'll keep highlighting as and when we get important updates from that one. But we have got important updates from Biocon. That stock is sitting with a gain of around 8%. InfoEdge is the other one, which is higher by 4%. In fact, some of the other IT names from the broader markets, the likes of eClerx, etc., have been doing quite well. And then Zomato is in focus. Remember, they've started this food wastages or a special program to stop the food wastage, and that's why that stock is in focus as well at the highest point of the trading session. Sampath, have you looked at any of these so-called new age tech names like Zomato, Paytm, Nykaa, etc.? Any thoughts?
We're not really on top of these companies, but especially the businesses like Zomato, Swiggy, we like those businesses. It's just that the valuation are way high. I think that's where the major concern is. But and others like Nykaa and Paytm and some of these things, we're not sure whether how and when will the profitability will be meaningfully large. But these food delivery as such. I think there's a good, the business case. We also, as I said, we also like the QSR as a space, and also the food delivery as also as a new age from a new age basket, new age tech companies kind of basket. We like those segments.
I just wanted to highlight the number at the bottom of the screen. The SIP data is out for AMFI and it's coming at a whopping 25,000 odd crores in the month of October, when we're all talking about that volatility and the fact that the FI exodus really continues. It's DIIs which have held one end of the market, and that DI of course fueled by the SIP money, Aisha. 25,000 crores. I think first time we have hit that number.
Yeah, absolutely. For the first time ever, it's a record high. And what's surprising is, like you mentioned, at a time when, the FIs, yes, they were in complete exodus mode. There were a bunch of IPOs which were clearly all that, money guzzler, and they did suck a lot of liquidity as well. And I'm not only talking about Hyundai and Swiggy. They, of course, were a little bit lukewarm, but there were a bunch of mid-cap IPOs as well. So other than that itself, with that kind of high retail participation, with the kind of nifty correction alone that we've seen, the SIP participation continues to be that high, 25,000 crore rupees, and that really is a remarkable feat. The faith in the DI community, or retail participants, I should say, clearly continues there.
And
Any
the
more
other
data?
the other bit is that the SMID schemes continue to see strong inflows. So yes, of course, large caps have seen increase in terms of the flows that they've gotten. But in fact, the large cap fund inflows have doubled to 3,450 crores. But the important bit is that money flows continue into the small cap and mid cap categories still. So there's no big redemption happening of sorts from that vertical. Of course, if you look at the thematic or sectoral funds, there as well, we have seen a bit of a jump up. And of course, the equity flows continue to be at record high level. focus funds have managed to do quite well. It's managed to surpass that 40,000 crore mark after 5 months. And of course, the SIP data up for you on the screen. We'll try and get an analysis going with either Sharad or get some experts to talk to us about this data, but nonetheless an important bit. Sampath, what's your take? Because it's clearly the DII money which is really supporting the markets, but can we really do without FIIs?
No, I think DI money has become quite large, and even overall, if you see the proportion of the ownership by the FIS have relatively come down. So the relative importance or the dominance of FIS have come down over a period of time substantially. And even if you see the the way the market is also today, the large caps are relatively more attractive, and while mid and small caps are generally still the valuation wise still on the higher end of the spectrum. I think that itself is also some sort of an indicator how the flows are impacting the overall valuation as such. If you look at the FIS ownership broadly has been in the the large cap oriented kind of companies, and with their selling, I think the overall relative valuations as such in the large cap segment are looking much better as compared to the mid and small cap. Generally speaking, the domestic institutions are a lot more bottom up in terms of investing style, and they do have a lot of exposure to the mid and small cap segment with a continuous positive inflows into the domestic institutions. Is also helping the valuations of mid and small cap companies still on the will be holding up. That's also sort of an indication why the mid and small cap still trading out is relatively expensive.
Oh yeah, absolutely. Wouldn't beg to differ. But great having you on the show, Sampath. Thanks so much for taking the time out.
If you like this video, then like, share and subscribe to ET Now.